Welcome back, traders. I would like to start the video first by saying I'm not a market manager. I'm not a financial advisor. These videos are created for your educational purposes only. Um, the whole point of me making these videos were to empower new or struggling traders with just some valuable information that can help them on their journey with trading. The whole idea came from I just start recapping my 3 years of trading, and I kind of said to myself, if I was starting over, what are some of the things that I would have liked to know that would have made my trading experience a lot of better. And from that notion, it prompted me to create this 12-part video to kind of put in a lot of the bumps and the bruises and the things that I learned that hopefully can help traders have a stronger starting point than just going out there with nothing. Please watch the first video. If you didn't already, I put them in a sequential order of importance. This video today will cover what trading platform to use, how to set up your accounts, and just some more basic, general, and essential information that you will need to know. The trading platform that I recommend traders to use is none other than TD Ameritrade. TD Ameritrade, I love TD Ameritrade. They are the reason I recommend them because they are very, very user friendly. Their phone line is open 24 hours, 7 days a week. You can call in with your questions, concerns, and things like that. And they are very helpful and friendly with their phone lines. And starting off as a trader, that is something that you need to know, that you have a supported platform where you can call in and be helped 24 hours, 7 days a week. In the first video, I talked about doing paper trading and then graduating with using small amount of money and things like that. One of the things that TD Ameritrade provides is a platform called Thinkorswim. This is the platform that most traders use. The platform is so good that it's almost that the style which professional traders will use. As you get into trading, you will probably use the Thinkorswim trading platform, but more importantly, it has a option to where you can start doing your paper trading. Now, when you paper trade, they give you $1 million to paper trade with. My recommendation is not to trade with $1 million, but you want to set that paper trading amount with the amount of your desired capital. So if you're thinking about starting off with 5,000 or 10,000, that's what you want to set your paper trading to, and you want to treat that paper trading like it's your real money. So you want to give yourself a realistic view. If I was going to jump in with 5 or 10,000, this is exactly what would happen. So you want to mock what actually will happen. So they're going to start you off with $1 million, but I recommend you changing that to the desired amount of capital that you want. Another benefit of TD Ameritrade, they have commission-free trades. That's huge. When I first started trading, it cost $7 per trade. So this is big because if you get into a trade and you at the place where you're going to break even, in the past with the $7, you would, even though you broke even, you would lose the $7. But the commission free trading, you can get in and out of trades for free, and that's just great. They do offer free education. A lot of people, especially like millennials, like trading on their phone. They offer phone trading. They have a phone app. So just all in all, with everything that they provide, TD Ameritrade is my recommendation for trading platform. Now, when opening your accounts, know and understand that you can open these accounts for absolutely free, no money. So I recommend you open 3 different accounts. You open one account that you're strictly going to trade from. You open one account for your long-term income, and you open one account for your retirement, Roth IRA. Um, because opening an account is absolutely free, you can get all 3 accounts started for nothing, and then whatever your plan is to fund your accounts or whatever desired capital, you could do that at your leisure. But having the accounts already set in play will put you in the right position for trading. So most people who go into trading have the desire to let trade full time or be an entrepreneur, or to get out of work and things like that. And if you're taking that leap of leaving your job and just trading, one of the things that you have to consider is retirement, because as an entrepreneur or a trader, you have to create or fund your own retirement. So one of the things that you want to do is have that Roth IRA in place. And as you make gains or money, you want to allocate a certain percentage of your gains to your Roth IRA, so that you are creating support for your future, for your retirement. Um, Also, you want to have a separate account for your long-term capital. Um, Most of the time in trading, the long game is the best game. Most of the money is made over longer periods of time, because one of the things you're able to take advantage of is compounded interest. And compounded interest is a great way over a long time to accumulate a lot of money. So one of the things you have to consider is, as you make money, when you make money from your trading, now what are you doing with that money? How is that money working for you? So you want to set up a long-term account, and in your long-term account, you want to put yourself in position to where you are getting letting your money work for you. Then you just want to have your account that's strictly trading. And one of the reasons you want to do that separately, so you going in and you going out, you like a sniper. You have no confusion, nothing is getting in your way. You have a very small watch list. You know exactly how much money you got. There's no confusions about anything, and that account is strictly for trading. Also, if you have children, it's a great time to get them started with their free account and just figure out how you're going to fund their account and put money in it. Children have the best advantage because they have time on their side. So, TD Ameritrade really provides you with the ability to start these free accounts. So, I mean, I would set 3 accounts for myself, and any children you have, you can start them account, and you can get going with funding, you know, at your leisure. Once your account is open, you will need to set a watch list. Here I have provided for you a default watch list. Later on in some of my videos, I will go over a walkthrough and how to create your own watch list. But until you are able to do that and you go ahead and set up your free account, these are some of the stocks that I recommend you putting into your watch list for day trading. One of the things that these stocks provide are, they have a lot of volume. Most of them are little to no debt. Most of them are good companies. just to get you started, for watching, paper trading, and things like that, just to see how things go. So these are the companies I recommend. These tickers to put in your watch list. Now, these companies are not the ones that I'm recommend that you trade in. Some of them will be as you get into it, but these are just companies to get you started until you learn for yourself how to do a stock screen and create your own watch list. So I'll be providing that video in the future. But if you do go today and open your own TD Ameritrade account, one of the things they want you to provide is a watch list. So this would be a good default watch list for you to set up. Now let's talk about some game-changing information. Game-changing information. When I first got started, there were a lot of things I didn't know, and over time, just in the blood, sweat, and tears of things, I learned some game-changing information that helped me become a successful trader. First and foremost was the debt-to-equity ratio. Um, I was able to take a free online course provided by Warren Buffett. It's called Buffett Books. Something I recommend all of you go do. It's free on YouTube. And one of my big takeaways from Warren Buffett and Buffett Books was the debt to equity ratio. When Warren Buffett looks at a stock, the very first thing that he looks at is the company's debt to equity ratio. If that company does not meet this requirement, he won't even look further on. And this is something powerful, because if a company has little to no debt and a company is making a substantial amount of money, over time that company will grow. It doesn't matter what product the company's selling, what's the news around it, or anything. If it has little to no debt and it's making money, over time it's going to grow. Now, if a company has a bunch of debt and it's not making money, it doesn't care how great or exciting that company, over time is going to bankrupt because it has a great amount of debt and it's not making a lot of money. So sometimes traders fall into the trap of liking a company or a product. It could be hot and sizzling, and they don't even have a clue about the financials of a company. So the first and most important thing that you want to look at a company when choosing it is the company's debt to equity ratio. So, and from the debt standpoint, Warren Buffett recommends zero point 0.5 or lower. I personally recommend 0.1 or lower. That means I'm a little more strict than Warren Buffett. And what that means is, for every 0.5 or zero point 0.1, for every dollar that company makes, it owes 50 cents in debt. And what I'm saying is, for every dollar that company owes, it only has 10 cents of debt or lower. And then as it relates to the equity, it's a standard that's called current ratio. And in the current ratio, that's how much that money company is currently making. And I like for the current ratio to be 2 or higher. And Warren Buffett likes it to be 2 or higher as well. So what that means, for every share that the company owns, the company is making $2. So when you look at it in the grand scheme of things, if you're making $2 a share and you only owe 10 cents of debt or no debt, over time, it doesn't matter if you're selling potatoes, tires, markers, paper, whatever, you are going to grow. So this is the very first and most important lesson that I learned, how to separate real companies from fake or junk companies, was learning the company's debt to equity ratio, learning what the current ratio is. That right there was a game changer for me, because it just got me out of the loop of just being in bad companies. And if you're in a bad company, you can lose your money. Another thing, the worst nightmare for a trader is a halt. And what that means is the company is halted or stopped, and then it goes under investigation because they were doing something illegal or they were doing something wrong, and the SEC is want to come in and evaluate them to make sure everything's right. And sometimes the halts can be disastrous. So one of the things that I like about day trading is that you don't experience overnight risk, like, because you're in and out of trades that very same day. Whatever money that you make or didn't make, whatever happened that day, and your money is not in harm's way overnight. But one of the things that you have to look at, the worst thing that can happen is that a company can get halted due to suspicious activity. Now, knowing and understanding the importance of debt to equity ratio, meaning that companies has good numbers and good books, the likelihood of a company with good numbers and good books of getting halted is very little to none. Now, most of the companies that pull off, they have a lot of Ponzi schemes, pump and dumps, all of these type of things going on. A lot of these companies get halted, and most of those are the companies who are broke, who have a lot of debt, that's not making money. They try to pull off these schemes, and if the SEC catch wind of it, that company will get halted. And most of the time, when a company get halted, it results in you losing a lot of money. So I definitely recommend to trade companies with excellent debt that are making money, because you have a great opportunity for those not to get halted. Most companies that are bad companies, penny stocks, bunch of debt, they are at high risk or high susceptible of getting halted. Another thing that you want to know and understand about day trading is the bid and ask spread. Now, what happens is the bid is these are bids of people who want to buy the stock. The ask is what people who own the stock is want to sell it for. So no one understand, when you're trading, you're not trading a computer, you're trading against another person. So it's a person that's selling the stock, and it's a person that's buying the stock. So you're buying that stock from another person. So the bid and ask spread determines the price of the stock. Now, as it relates to day trading, you want to make sure that the bid and ask spread is very close, within pennies, 2 pennies at the most, or pennies of each other. Because in the first video, I said we want to take on trades with 3 to 1 ratio, and you want to try to make, I just gave the example of 21 cent, you only want to lose 7, but those numbers can change based on your discretion, as long as it's 3 to 1 ratio, meaning you could be trying to make $1.50 and only lose 50 cent, whatever 3 to 1 ratio, is based on the stock. But you want to have companies that have very tight bid to ask spread, because if a company has a bid to ask spread that are within 10 cent or 15 cent of each other, I mean, you can get just wiped out for nothing. Like you would get your stopwatch. Like, soon as you put the trade in, it'll go right to your stopwatch, because it's such a gap in between what people are bidding and what people are asking for the stock. So one of the things when you are paper trading or mock trading or looking at stocks, on a daily basis. You want to pay attention to the bid and the ask spread, and you want to make sure that they are no more than 2 cents or pennies are within each other. For day trading, I like stocks that don't move very fast. I like them to move very small in small increments. One of the things, some people don't like this because you don't make a lot of money quick, but you have to look at the flip side. It's hard for companies that don't move at that great ratio. You're not going to lose a lot of money. And I told you, winning traders focus on not losing, or focus on the losing side and not the winning. So companies with good bid and ask spreads are good companies because it kind of helps you monitor your losses, and you won't lose. So that's something that you want to pay attention to. Another thing, whatever stock that you're trading, you want to know which index it follows. The stock market is made up of three major indexes. You have the Dow, you have the Nasdaq, the S&P 500. So when you got that stock ticker, you want to look at which um, index is this company following. And this is important because you want to trade in the direction of that index. So let's just say your company, let's use ticker symbol GOF that I gave in the default watch list. Let's just say it was a part of the NASDAQ. And let's say the NASDAQ was going up, but I was trading down. Most of the time, I'm probably going to lose on that trade. So if the NASDAQ is going up, I want to make sure I'm trading in the same direction as the NASDAQ. So whatever stock ticker symbol, you want to know which index it follows, and you want to trade in the same direction of that index. Because if you're going against that index, more 9 times out of 10 you're gonna lose, because most of the companies in that index kind of follow the same. Uh, those companies follow the same direction of that index. Um, when you set up your watch list, your default watch list, one of the things that you want to set for your chart form is candlestick. Now this is very important because they have very many different chart forms, but why I like the candlestick setup more important, because candlesticks represent every dollar that was spent in the market for what that given period of time. And one of the things that you have to understand is money doesn't lie. So candlesticks represent every dollar, whether it was up or down, within that time period spent. So it's very important when you set the form of your chart, you want to set it to candlesticks. Um, Another thing that's important are indicators. Now, indicators are just that. They are indicators. Just like you watch the news and it gives you an indication that it's going to rain, more than likely it's going to rain. Is it 100%? No, it's just the indicator. So there are some indicators that I like using, that kind of helps me with my trading. I like moving averages. I like the 200 SMA. That's called, stands for simple moving average. I like the 20 SMA. That's a simple moving average. So what happens is stock is essentially math, and moving averages, they calculate the company's averages over periods of time. So it's a lot of math done, but it's like the moving average does the math for you. And one of the things when you start paper trading, you'll find that these stocks really hold tight to or stick to or follow these moving averages. And when they go from one direction to the other, they actually bouncing off one moving average to the next. When I first got started, this was something I really didn't understand, but when I started really learning and understanding the moving averages, it kind of blew my mind because stocks, they really hold to or stick to moving averages. So as you get in your watch list and you set the form, the candlestick, put up the 200 simple moving average and 20 simple moving average. Those are two powerful moving averages that will help you in your trading. The 200 simple moving average is good for long-term trading. The 20 simple moving average is a must for day trading. Another indicator that is very important as it relates to day trading is volume. What volume represent is the amount of people that trade for that given period of time. And know and understand that you're not trading a computer, you actually trading for another person. So if I have a company, if I have a stock and I'm trying to sell it, but if it's nobody there to buy it, then I'm going to be stuck there with that stock. But if it's a lot of volume, meaning you have a lot of buyers and a lot of sellers, you won't have problems getting in and out of your stocks or moving your stock. So for day trading, I only trade companies that have a 500,000 volume or higher, because when I make my gain, I want to be able to get in and out of it. So that's something that's very important, is that in day trading you want to trade companies with at least a 500,000 or higher. And it might even be better to do companies with 1 million volume or higher, but at least a 500,000 or higher, because you want to be able to get in and out of that stock. And finally, another moving average that I really like is called Bollinger Bands. Bollinger Bands for day trading. And what Bollinger Bands is, are a band of moving averages. You have the 20 simple moving average normally is in the middle, and then the top is 2 standard deviations, and the bottom is 2 standard deviations in the other direction. And again, it's a lot of math, but I love it because they essentially do the math for you. And one of the things that you will find is the stock really bounces off these moving averages and these bands and things of that nature. So I will be in a later video showing you some realistic trades and things on an actual candlestick chart, and I'll have the indicators up and really show you how they work. So stay tuned. I'd like to personally thank you for watching the video. I want to ask you to please hit the subscribe button, smash the like button so it can get into the algorithm to help traders who might benefit from the video, and stay tuned.